Most traders would have entered from this FVG the moment it formed. And here's the strange part. They would have actually made money. So why did I completely ignore a setup that worked perfectly? Was the FVG invalid? Did I see something everyone else missed? Or was there a much better entry hiding on the chart? In this breakdown, I'll show you the exact liquidity clues that kept me out of the FVG and led me to a higher quality entry instead. And once you see it, you may never look at FVGs the same way again. The first thing that caught my attention was this demand zone. As price started approaching this area, I wasn't looking to jump into a trade immediately. Instead, I wanted to see how price would behave once it reached this zone. Because if institutions were truly active here, they would eventually leave footprints on the chart. And what happened next gave the first clue that something much bigger was developing behind the scenes. As price moved lower, it started creating inducement below these lows. To most traders, this looked like a strong support area and a perfect place to start buying. But from a liquidity perspective, those lows represented something much more important. They became a pool of liquidity that smart money could target before the real move began. And once I recognized where that liquidity was resting, it became clear that price wasn't finished yet. In fact, the next move revealed exactly how institutions were preparing for the expansion higher. After the inducement was created, my attention shifted to the internal liquidity forming inside the range. These smaller liquidity pools may look insignificant, but they're often used as stepping stones by smart money. Instead of moving directly toward the final target, institutions often engineer liquidity within the range first. And that's exactly what price began doing here. Once I saw internal liquidity being developed, I knew there was a bigger objective above the market. The question was no longer if price would move higher. It was where that move was ultimately headed. But here's where the entire setup became interesting. At this point, I already knew where internal liquidity was forming, yet I still wasn't looking for an entry. Why? Because there was one crucial piece of the puzzle still missing, and without it, buying here would have been nothing more than a guess. Once that missing piece appeared, the entire liquidity narrative became clear. And that's when I knew exactly where price wanted to go. Once the internal liquidity was formed, the next thing I identified was the external liquidity resting above these highs. This was the real objective. Because external liquidity is where a large concentration of buy stops typically exists, making it an attractive target for smart money. And when I connected that target with the liquidity being engineered below, the entire narrative started to make sense. Institutions weren't just reacting to price. They were building a path toward a much larger pool of liquidity. The only thing missing now was a confirmation that buyers were truly stepping into the market. Now this is where the setup started becoming really interesting. After reacting from the demand zone, price expanded aggressively to the upside and left behind this bullish order block. For me, this wasn't just a random candle on the chart. It was the footprint of institutional activity and a potential area where buyers could step back into the market. But something else was created during this displacement, an FVG. And before you ask why I didn't mark it or use it for an entry, don't worry. I'll explain exactly why later in the video. Because understanding why I ignored the FVG is actually one of the most important lessons from this entire trade. For now, my focus remained on whether price would come back and respect this order block. As expected, price eventually retraced back into the order block. Now this was the moment I had been waiting for. Instead of entering blindly, I wanted confirmation that buyers were still defending the area. And that's exactly what the market showed. Notice these strong rejection wicks forming from the order block. Every time price attempted to trade lower, buyers stepped in and pushed it back up aggressively. This told me that the order block was still being respected and institutional demand was likely active. With the liquidity narrative already pointing toward the external liquidity above, this confirmation gave me the confidence to execute the trade. But here's the interesting part. Most traders would have already been in the trade long before this happened by using the FVG. So why did I willingly wait for this confirmation instead? Now let's answer the question you've probably been waiting for since the beginning of this breakdown. If the FVG worked perfectly, why didn't I enter from it? The first reason is that the demand zone was the cause of the move, while the FVG was simply the result of the move. Professional traders often prefer entering closer to the source of institutional activity, rather than chasing the imbalance created afterward. The second reason is that the FVG was sitting above a stronger institutional area. If price wanted a deeper retracement, it could still return to the demand zone below. So, from my perspective, there was no reason to rush into a trade when a higher quality area was still available. The third reason was confluence. The order block gave me much more information than the FVG alone. Not only did I have the demand zone and liquidity narrative supporting the setup, but I also had strong rejection wicks showing that buyers were actively defending the order block. The fourth reason was trade efficiency. Notice how large this FVG is. A larger FVG often requires a wider stop loss, which can reduce position size efficiency and lower the overall risk-to-reward profile of the trade. By waiting for the order block retracement, I was able to get a tighter and more precise entry. And finally, I already had a complete liquidity narrative. Inducement had been created. Internal liquidity had been engineered. External liquidity had been identified as the objective. At that point, I wasn't looking for more reasons to enter. I was simply waiting for confirmation that institutions were still defending the market. And that's exactly what the order block and rejection wicks provided. So yes, the FVG worked, but a setup working doesn't automatically make it the best setup. Sometimes, the highest probability trade isn't the earliest entry, it's the most efficient one. This trade is a perfect example of why understanding liquidity is more important than memorizing patterns. Instead of chasing the first available entry, I focused on the complete story being told by the market. We had a demand zone, inducement, internal liquidity, external liquidity, an order block, and finally, confirmation through strong rejection wicks. When all those pieces aligned, the trade became much clearer. Remember, smart money uses internal liquidity as stepping stones to reach external liquidity. And if you can learn to follow that narrative, you'll start seeing the market from a completely different perspective. Thanks for watching, and I'll see you in the next breakdown.